Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day, and today we're bringing you a historic event. I have brought the Mount Rushmore of gold experts to the table. Andy Schectman, CEO of Miles Franklin Precious Metals, Alasdair Macleod, Head of Research for Gold Money, and Steve Hanke, Professor of Applied Economics at Johns Hopkins. We're coming together for a conversation so epic it can only be called the Ultimate Gold Roundtable. So strap yourselves in and let's do this. I would like to begin today's discussion on the US dollar versus gold and your thoughts on the recent BRICS Summit in Kazan. Now, it disappointed many as there were expectations of a gold-backed currency, partially backed by gold, partially backed by commodities. There's been discussion of this BRICS unit. In fact, I believe there's even been a white paper released on it. There was no announcement, leaving many disappointed. What we got instead was more of a symbolic gesture, if you will, with Putin holding some kind of BRICS currency bill, which left many not so happy, hoping that there was going to be this currency announced. What are your thoughts there? And how do you currently view the strength of the dollar right now? Do you see it in decline? Does it have plenty of steam left? And Andy, I'll start with you on this one.
Well, I'm going to answer the second part of the question first, and then I'll come back to the first part about the BRICS meeting, which is really, I don't know. I think it may be concerning is the wrong word, but we'll talk about it in a moment. Look, while the dollar's dominance isn't going away tomorrow, I think we can see we're in the early stages of a form of a gradual shift as more countries look to diversify away from the dollar. And that was one of the overreaching themes at the BRICS meeting, that there is this growing interest on reducing reliance on the dollar and more currencies looking to use alternative forms of settlement, like gold, like regional currencies for trade. Again, this was certainly talked a lot about at the BRICS meeting. And look, when you talk about the issues with the United States, we have a $36 trillion debt. We have unfunded liabilities exceeding almost $200 trillion. Our fiscal irresponsibility of creating nearly $100,000 of debt per second, every single second, 24/7, nearly $1 trillion every 100 days. It took 200 years to do that the first time. 1 trillion seconds ago was 31,688 years ago. So we have an overreaching debt problem. We have fiscal and monetary irresponsibility. We have weaponization of the treasury market. All of these things we've talked about ad nauseum. And then, of course, we have the things here in the United States that make much of the world kind of look cockeyed, like when you say something to a dog and it goes like this. Well, that's kind of the way I think people are looking at this country, the institutions that made this country so special. When I was a kid growing up in the 70s, you said, yes, sir, yes, ma'am. You held the door for a woman. We were proud of our immigration standards. People came in this country legally. They assimilated. They contributed. People are looking at the world now like, what's going on with that? The FBI and the judicial system. These were pillars of this country that now people look at and say, is it two-tiered? Is it fair? Whether or not we believe it is, much of the world does. And then, of course, the elections, a week away from the elections. And there are people, whether or not we agree, that question the authenticity of the elections. These are pillars that made this country special. We used to be united and stand behind these pillars of strength, these pillars of principle, of freedom, of integrity, of everyone was equal under the eyes of the law. All of these things that people risked their lives for to come here in inner tubes tied with string to float from Cuba or walking from Central America. I'm not talking about what's happening now, but from way back when, to leave authoritarian regimes to find all of these things. Yeah, that's not the case anymore. We're a divided country, and all of the things that I just mentioned make people scratch their head and say, what's happening in the United States? So it's not the same country that has perhaps the unity and the resilience to stand up to these kinds of changes. That's first and foremost. That is what is incentivizing all of this. But look, we could talk about the BRICS gold exchange that they're talking about. We could talk about the the BRICS Pay or the BRICS Clear. But what I want to talk about briefly, the one thing that really is shocking to me is what you mentioned, the unit settlement currency. I've talked a lot about it. Dilma Rousseff, the former president of Brazil, the head of the BRICS New Development Bank, came out just a few weeks ago in a meeting that coincided with the G7 meeting in Italy that the Saudis turned down an invitation to, yet sent their delegates to the BRICS meeting in Novograd. And Delma said, yeah, we've agreed in principle. Meetings on the sideline with Putin and Sergei Glazyev, the architect of this, who he's the reason I've talked about for almost 4 years, a basket of BRICS plus currencies and a basket of commodities that would back this new settlement currency. And she said, yeah, we've agreed in principle. It will be the unit settlement currency token traded over Enbridge. Now let's just focus on Enbridge for 1 second, because what happened, I think, is only going to substantially increase the resolve of these countries. And it really it lends itself to one of these moments like, what? So we've talked about Enbridge, a cross-border payment system that was designed by China, Hong Kong, Thailand, United Arab Emirates. It would give these BRICS countries the ability to trade with one another using local currencies, free from the SWIFT interference. And this has been known, right? And it was backed by the BIS Innovation Hub, which always kind of made me like, well, that's kind of strange because this is a Western institution. And I had various theories on that, but the BIS Innovation Hub has been at the forefront of this development, this technology with China, Hong Kong, Thailand, and United Arab Emirates, and then the fifth full-time participant being Saudi Arabia, a platform that is not compatible with US dollars that we are told will be the settlement platform to trade the unit, a token that will be comprised of 40% gold, 60% BRICS plus currencies, and redeemable in gold. And at the 12th hour, you now have the BIS say, yeah, we're going to pull the plug because we can't be involved in anything that will allow sanctioned countries to trade. You have a spokesman for the State Department who just came out and said, yeah, any system that will challenge the SWIFT, any alternative to the SWIFT system and the dollar threatens global democracy. I mean, the hubris of that, the craziness of it. But I guess my point that I wanted people to take away from this is at the 12th hour, after years of development in Enbridge technology, specifically so that these countries could trade with one another in local currencies outside the SWIFT. Now the BIS pulls the plug. Now they say they can't do this right after it had been, it's openly trading in its minimum viability, but it is out there. And now they do it. It just makes you say, what? So that to me is one of the most interesting developments. Aside from all of the important developments, this is just almost like a James Bond movie. You can't make it up. That they come in, they develop it, they get them going, they get it ready to go, and bang, right when they introduce it, we're out, we're pulling the plug on it. I think that's going to lead to some unintended consequences that will only further and strengthen the resolve of these countries.
Alasdair, your thoughts on the BRICS Summit and the current strength or weakness that you see in the US dollar?
Yeah, the thing about the BRICS Summit is it's highly political, and I don't think people really understood just how political it was. I mean, the whole of this business of a gold-backed trade settlement currency started when, I think I'm right in saying, the Russian embassy in Nairobi put out a story that this was going to be on the Johannesburg agenda. It didn't make the agenda. And it hasn't made this agenda. And I think there are very, very good reasons why. I mean, India has reportedly been very much against it. And I can understand that. India tends to be Keynesian in its economics. And not only that, but it trades with both Asia and also the West. And to bring in a gold-backed currency of any sort risks destabilizing the fiat currency world. And India doesn't want to be in that position, nor does China. China has exactly the same problem. And China also has a philosophical approach to these things. She would rather we made all the mistakes and she just sort of sits there, benefiting from our mistakes. That's been her strategy. It's sort of Confucian, if you like. Why interrupt someone when they're making mistakes to your advantage? And that's her approach. So she's just sitting on her hands and not interested. I think the only nation which has a clear benefit from a return to gold is Russia, because if she made the ruble a credible gold substitute, then gold would flood from everywhere. In the West, its lease rate is 2%. The deposit rate of the Central Bank of Russia is around about 18%. What's not to like on that arbitrage? And that is what gets gold flowing from one center to another center. And I think, Russia is the only one in the BRICS which really has a very substantial and sustained trade surplus. It's not like China. China trades off her imports by exports, and where there's a difference, she'll go and sort of spend some money investing in infrastructure or whatever it might be. Russia is the one with the problem, and that's why she got the hair running, I think, back in Nairobi ahead of the Joburg summit. I think we have to dismiss, for the foreseeable future, any idea of a return to a gold standard currency. Having said that, of course, Russia and China and others in Asia have been accumulating gold as part of their reserves, and also, I guess, in their wealth funds and various government accounts, which we're not privy to. I think the reason for this is really quite simple. She sees that the US is in a debt trap, the US government is in a debt trap, and that debt trap is going to drive interest rates higher because, who are the marginal financiers? Basically, it's the foreign nations and their institutions who already have, according to the Treasury tick figures, something like 32.5 trillion tied up in dollars currency and also underlying financial assets. So, it's sort of looking like end of the road. Now, when these guys see that Donald Trump is almost becoming a shoo-in for the next president, they're now looking at a Trump-led America, I think, with some trepidation. They have heard the headlines. They have seen the headlines. Trump loves trade tariffs. Trump wants to cut income tax and corporation tax, which basically means that the budget deficit will increase before the benefits of that, if they ever come through. So you can see from a foreigner's point of view, they're not buying gold, they're dumping dollars. And that's what's really been happening. And this also explains why it was that when Putin made it clear on the Friday before the BRICS meeting that a gold-backed trade settlement currency or a trade settlement currency of any sort was not on the agenda, gold continued to rise. It was not reflecting disappointment, if you like, that this much hyped idea was suddenly going to happen. What it was I think it was an increasing concern in Asian circles, certainly, that the dollar is in a debt trap, and the consequence of that, in the absence of an administration prepared to face up to it, the consequences are dire, and I think that's roughly where we are.
And Steve, is the BRICS unit a pipe dream? Is it a reality? Could it come to fruition at some point in the future? And what are your current thoughts on the US dollar's reserve currency status and its continued strength or weakness moving forward?
Well, first of all, in terms of the strength of the US dollar, obviously in the short run, or intermediate even, it's extremely strong right now. And it's unusual in a way when you think about what Andy was talking about. The U.S. has been in a full-scale, let's make enemies with everybody we can find in the world kind of mode, and not in a diplomatic mode whatsoever. Obviously, the Washington, D.C. crowd has never read Dale Carnegie's book on how to win friends and influence people. And that's what BRICS really is about. It's a diplomatic configuration that's coming together. But when you talk about the dollar, uh, and the U.S. and this kind of the image and atmospherics of creating a lot of enemies, mainly among other reasons, precisely because they're weaponizing the dollar and the dollar financial system with sanctions. You know, every day you open the paper and there's some new set of sanctions on somebody the U.S. doesn't like, or Europe doesn't happen to like. So, at any rate, the dollar is in fact very strong, and the U.S. If you look at the economy, we can go on with all the, you know, the debt isn't sustainable. It can't go on. And by the way, if something isn't sustainable, it'll stop. So we have all this litany of problems, but I think the best way to look at it is that the U.S. and the U.S. dollar, they're still the best dirty shirts in town. That's what's really going on. If anyone trading currencies knows very well, there are always two sides to the coin. And so if you look at the dollar and the U.S. economy in that context, in relative terms, it's as I say, it's still the best dirty shirt in town. Now, looking back at the international currencies, the U.S. is clearly basically unchallenged as the international currency. And if you go back 2,000 years, there's always been one international currency. And if you go back 2,000 years, we've had 14 of them. So they don't change. It's hard to knock a king off the throne. It doesn't happen very fast or very frequently. So that's kind of the context that I see the dollar. A lot of hype around it. Yeah, it's been weaponized. The U.S. has a lot of enemies, this, that, and the other thing. But the dollar is still king, and it's not going anyplace fast. And if you look at the short-term thing, by the way, with problems, why is it so strong? One reason, when there are international conflicts going on and wars going on, the international reserve currency, namely the U.S. dollar, gets strong, and it is strong. I think the fair value of the U.S. dollar, the fundamental values, probably against the euro anyway, about 120 to 140, something like that. Well, it's been on the strong side for a couple of years now, and every time it looks like it's going to creep back into the kind of what I consider the fair value range, it just basically turns around and gets stronger. So that's it for the BRICS. I think it was an important meeting in terms of geopolitical, the political aspect, a very important diplomatic aspect. However, there was more talk than action. The only thing that really happened was that it looks like the Chinese-Indian border problems are going to be tamped down and settled. I mean, that was a big deal. That was something concrete that happened. As far as the other things, one thing that they put forward, which is a little bit like the gold-backed currency, is the grain exchange, a BRICS grain exchange. But if you look at that, it's so far from a reality that it's unbelievable. Number one, there's no location. Where is this going to be? And there's no business plan. There's basically nothing. There's no feasibility study or anything. They're just talk about it. So we go now to the end game. Our main focus is the gold-backed currency. Well, the gold-backed currency, it's very easy to set one of these things up. I wrote about this, by the way, in a Forbes column. I've written about it many times, but December 3, 2017, how gold would fix Turkey's Achilles heel, the lira. And I actually have a draft law of how you would issue a gold-backed lira or a gold-backed anything. I followed this up, by the way, with another article in Forbes about a year later, a gold block for Iran, Russia, and Turkey. Oh my, Forbes, August 22. 2018. Well, that article actually did see some light in Moscow, because there were representatives from Iran, Turkey, and Russia who actually met and discussed it, but nothing ever happened. And how would you do this? Well, you'd have a currency board arrangement. You would issue let's say a brick, and that brick would trade at a fixed exchange rate and be freely convertible with gold, and it would be fully backed by gold. So what would the brick currency be? It would just be a clone of gold. If you didn't like the currency, you just exchange it for whatever the gold fix was that you happen to have, and it would be credible because they'd have 100% reserves backing the issuance of the BRICS currency. So at any rate, that in short, the dollar is strong. The dollar is not going away anytime soon. Yes, the U.S. is engaged in one stupidity after another, and mainly sanctions as they relate to the financial weaponization of the U.S. dollar, which does clearly make it more vulnerable. It does cause people to start talking about alternatives and trying to figure out some way around it. But it turns out that it's hard to knock the king off, because it's hard to come up with a credible alternative. So that's, and as far as the BRICS meeting, you got my take on that. So there we are, Jesse.
Hey guys, just a quick break to hear from today's sponsor, ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. Yeah, fantastic thoughts from all of you. I want to discuss where gold is at today. Obviously, we're clearly in a gold bull market as prices continue to push to new all-time highs. I think the question on the minds of many is, what inning are we in here? Is this still the early stages of a longer-term bull market? Are we getting oversold at this point? You know, I spoke to Dave Collum on the show recently. He said he's feeling irrationally exuberant when the gold price, and usually when that occurs, he ends up getting slapped around. So he has some concerns here. Where do you think we're at, and what are the catalysts that could drive gold higher from here? Alasdair, I'll start with you on this one.
Yeah, I think it's, we all look at this the wrong way around. I mean, the history of gold is, it was legal money going back to Rome's 12 tables in about 448 BC. That was the first attempt that Rome had at setting up laws which defined our behavior. And in that, they defined the difference between money and credit. Money being something with no counterparty risk, which settles a transaction absolutely and finally, and credit being something with which isn't a final settlement and is always matched by a liability. Someone has the liability, and the situation as far as looking at the value of gold in terms of goods, services, and all the rest of it, is that its purchasing power is broadly unchanged over very, very long periods of time. I was looking at Diocletian's Edict of Maximum Prices, and the value of these prices in gold, some of them were very, very close to what we see today. There are others which have dropped out. We don't have slave markets anymore, for example. There are others where prices have actually, either increased substantially or decreased substantially. But generally, the purchasing power is pretty even the whole way through. And if you look at the purchasing power of gold with respect to West Texas Intermediate oil, I think I'm right in saying that back in 1950, oil was round about $3.50, $3.53 a barrel. And today it's sort of like 70, but the price in gold has just sort of motored along. I mean, it's gone from 2.5 times what it was then to maybe 50% of what it was then. This is considerably less volatile than any fiat currency. Now, the point I'm trying to make is that when you look at the relationship between gold and dollars, for example, really what you're looking at is not the purchasing power of the dollar so much. Well, you're not looking at the gold price so much, but you're looking at what's happening to the paper currency, the dollar. And the thing about gold is it is international. It is internationally money. It's in everybody's common law, whatever the government propaganda says. And this is why, if you want to vote against the dollar as a foreigner, then your natural place to go actually is to go to gold. And I think that's what's happening. It's not that, say, the PBOC is buying gold. It's more a question that they're selling dollars or they're reducing their dollar liabilities. And that's the way to look at it, I think. That being the case, the only thing that's going to turn around this relationship is a very, very sudden turn in US economic and monetary policy. But so many people get harmed by that. It's very hard to see that being a deliberate act of policy. But until that happens, I'm afraid the purchasing power of the dollar, and in Steve's word, the least dirty shirt, that's going to continue to decline, and it's going to take the other currencies with it. The other currencies are worse than the dollar. I mean, you can see that in terms of what's happened to the gold price in those currencies. And, you look at the euro. I mean, the euro as an international currency seems to have declined in terms of its use in transactions, while, the dollar has held relatively steady at around about 50% of all estimated transactions. This is the point I really try and get over is that what is moving is it's not so much the gold price, it's more the value of paper currencies. And that should alarm us. That really should alarm us.
And Steve, do you concur? Do you have any disagreements with what Alasdair has stated there? I know you also have a gold sentiment algorithm that you use. I'd love if you could shed some light on that and what it is currently telling you about the gold space as well.
Okay, well, I do agree with Alasdair, and I just reached back in back of me, and Alasdair, remember this?
Yes, I do. Certainly. Yes, the Vardimecum of gold bars.
the golden constant, Roy Jastrom's classic. So let me. You asked whether we're in the early innings or late innings, and I think we're in the early innings, consistent with what Alasdair said. Because if you look at gold, the price of gold, it should be facing quite a few headwinds now. Actually, the dollar is very strong. Real interest rates are going up. Inflation finally is coming down all over the world, and inflation expectations are coming down. And what's going on? The price is going up. The price of gold is going up. So something is going on that's unusual, and I think Alasdair put his finger on the nub of the problem is that people are just lightening up on fiat currencies, and by the way, if you look at the World Gold Council, yesterday they came out with the third quarter results, and one interesting thing, we all know that central banks have been buying, and who has not been buying are ETFs, but that changed around in the third quarter. ETF buying is up big time in the third quarter. It's the first time ETF incremental buying has been positive since the first quarter of 2022. So I think we're in the early innings of something going on here. That's basically my bottom line on that. Now, you did mention something that I would like to talk briefly about, and that's Hanke Kaufman's gold sentiment score. And what Abe Kaufness and I started doing about 3 years ago, actually, we started doing the research on it before 3 years ago, is developing text mining techniques so that we could determine whether articles coming out were either bullish or bearish on gold. And we look at 20 articles, the top 20 articles coming up on Google every hour, and text mine those and determine and score them as to how bullish or bearish they are. And the range of our scores, the most bearish is a -10, the most bullish is a +10. And what we find, this is high frequency data. So this is trading. This isn't whether gold is in a bull market or a bear market. This is for entry and exit points, or people who maybe will be trading in and out of the market 2 or 3 times a day. And what we're finding out over these 3 years and 50,000 scores, by the way, of bullish, bearish over that period of time, is that if you reach an extreme, let's say you reach an extreme where everybody is hyper bullish, what happens is that extreme shifts back to neutral or bearish. So there's a reversion from these extremes, either bullish or bearish. So if you're trading and you notice a extremely bullish reading, what do? What you either want to unload your long position or put on a short position, because the thing's going to revert back towards neutrality or bearish. And we're looking at the opening and closes in the Australian market, Dubai, London, and New York every day. And you can find this, by the way, by going to the Gold Sentiment Report, www.thegoldsentimentreport.com, Jesse. And if you're inclined to purchase the service, it's $19.95 a month.
Great. Well, I'll put a link to that in the description below. Absolutely, yeah.
So it's quite exciting, and we're advancing the thing. We're ultimately, we want to develop algorithms that are hooked into the score that will be allowing for trading. And we're also now starting to look at some experimentation with headlines, not the text themselves, but just the headline of the article on gold. Is it bullish or bearish, and how bullish and how bearish is it? So there's, as far as I know, of course, as technical traders know, there's been technical sentiment indicators and measures and metrics around for a long time, but there's never been anything like this where you have real time, a finger on the pulse of bullishness or bearishness as it's coming out in the press hour by hour. So it's really been quite exciting, and particularly given this reversion aspect, because that's really in stone. You get these extreme bullish or bearish readings, and bang, it goes back the other way.
Very interesting. Andy, your thoughts on where we are in this current gold bull market? What are the catalysts that you see potentially driving gold higher?
Well, these guys are so smart. I do want to touch on a couple of points that both of them said. As far as what Alasdair said, he's right. It's not that gold goes up. It's that the currency that we measure gold in, the fluctuations of those currencies in particular. In the dollar, I did an interview the other day with a gentleman who said to me, Andy, money creation, which is really the definition of inflation from a classical sense. It's always a monetary event. It's an increase in inflation of the money supply is inflation. Price inflation is a different thing. But when we talk about money creation averaging 7%, I would argue that's a little light, but let's just play that out. He said, for the last decade, it's at 7%. Well, ironically, when we apply the law of 70 seconds to that, which says you take your interest rate and you divide it into 72, and it tells you how long before your principal doubles. So 10 years ago, the dollar was worth twice what it is today by that standard by money creation alone, by inflation, or pretty darn close to it. And gold was $1,200 an ounce then. So did gold nearly double, or actually just over double, rather? Or did the dollar lose half of its value? I think that's the important thing here, is that gold is the barometer by which we measure the health of the system. And I think the dollar has a long way to go in terms of where it ultimately ends up. It should be much less than it is. The justification for a dollar as strong as it is right now is ludicrous. I mean, we're right at that 120-ish% debt to GDP level, where back when I started in this industry, anything over 100% was a banana republic. And, then you throw into it all the things that I talked about in the previous question, centering around, election integrity and judicial system and all of these things. And you wonder, I mean, isn't that what people used to say was a banana republic? Election interference and debt well over 100% debt to GDP. So we'll sidestep all of that for a moment, but this is one of the reasons why I think you're seeing such a strong drive to gold. I mean, forget about the fact that going back for 25 years, gold has doubled the performance of the 10-year Treasury and has beat the performance of the S&P 500 with dividends reinvested, which has averaged about 9.6%, with gold right around 9.9% for 25 years on average. So its performance is better, but these are assets that have plenty of counterparty risk, as we see, where gold has none. To Steve's point, I know, Steve, I look like I have such a baby face, but I've actually been doing this for 35 years. And I read that book by Roy Jastrom, The Golden Sexton, and I remember a long time ago something sticking with me in that book. And that was, if I remember correctly, the overwhelming theme that, yes, gold does very well in inflation, but actually does better in a deflationary environment, as it is an asset that has no counterparty liability. And so kind of Richard Russell's old saying, he or she who loses least wins, and having an asset like that maintains no counterparty liability, doesn't have the systemic risk built into it, to me, makes it even more valuable than it is in dollar terms. And this is one of the reasons you're seeing the BRICS and all of these countries in the global south accumulate gold, because of the counterparty risk of holding treasuries and because of the irresponsibility in our fiscal policy, which is very easy to see, and you can understand why these countries are doing what they can to protect themselves. Also, to Steve's point, talking about the strength of gold, even in the face of positive real yield, a strong dollar, and ETF outflows over the last 2 years that have fallen at a 45-degree angle. Now, albeit they are starting to turn up a little bit right now, the large move that we've seen in gold, it was void of American participation. And if you would ask someone who is mainstream oriented and say, what would gold do in an environment of a strong dollar, positive real yield, and massive outflows out of the ETFs, virtually, signaling no participation by the American public, one would think that the price would collapse. And when you look at what happened in Lindsay, Oklahoma last week, with what I would argue is the first bank bail-in that we've seen, where the bank failed, FDIC took it over, 50% of all of the insured deposits were transferred to the new bank, 50% of the uninsured deposits were transferred, and the other 50% says, well, they say, maybe you'll get it, maybe, over the next 4 years, as they unload the assets of the bank, where earlier in the article they say the assets are far less than the liabilities to creditors and others, whoever others are. But the point is, there hasn't been an awakening yet, a real awakening as to the benefit of holding gold, an asset that is not systemic, an asset that has no counterparty risk, an asset that has outperformed the S&P 500, an asset that has outperformed the 10-year Treasury, far contrary to what most people tell you, an asset that doesn't pay a coupon. So what? It's outperforming many of those that do. And if we believe the nonsense coming out of the BIS, I think we should scrap the I right out of it and put just the B, or the BLS, rather, Bureau of Labor Statistics, and call it the BS. And the CP lie, where they're trying to tell us that inflation is only at 3%. It's not. I wish it were, but it isn't. It's much higher than that. Ask John Williams of Shadowstat. He'll say add 8 behind that, and you get 11%. So we talk about the real environment as a negative real return, and an asset that doesn't pay a coupon that is performing the way that it is certainly beats the hell out of an asset that is yielding a negative real return. It's just the metrics by which the government gauges inflation is messed up, to say the least. All of this, I think, signifies the motivation behind those countries around the world that are accumulating metals. And I don't think it ends anytime soon. I don't think, look, the dollar has signaled inflation over austerity, the way that all politicians have forever. And even if we balance the budget today, who the hell is going to pay for our unfunded liabilities? The 77 trillion unfunded in Social Security, 99 trillion in Medicare Part B, Medicare Part D, 20 plus trillion, the pensions, government military pensions, all of these unfunded liabilities on top of a $36 trillion debt, on top of ridiculous fiscal irresponsibility and brain dead monetary policy. This is why central banks are accumulating gold. There's no question about it, in my opinion. And, you know, that doesn't mean markets go up forever. They breathe, they exhale. There will be pullbacks. One thing that I've noticed that is very shocking is the shallowness of the pullbacks. They're very shallow and they shoot right back up. And in my opinion, and maybe I'm in a minority on this, but I've been very vocal on it, the LBMA and the COMEX were exchanges that were designed to offset risk. They've turned into much more than that. On the LBMA right now, you have between 4 and 6 billion ounces short in silver, where these banks, these commercial banks, which I believe are facing an existential threat, are trading up to 2.9 billion with a B ounces of silver per day. That's 3.5 times annual global mine supply. Now the numbers say 290 million per day, but they say those numbers are up to 10 times understated due to they only post the final settlement numbers, not all of the ins and outs and ups and downs that the trades that they take to get to those final settlement numbers. They have 800 million ounces of silver on the LBMA, approximately, of which 500 million belongs to the ETFs. They have a float of 300 million ounces, and they're trading that entire float every single day. And if you look at the actual trades, it's 10 times that amount every day, double the annual global mine supply in gold. But most of these trades, 90+% of them, are naked short on paper. On COMEX, you have 8 banks, 8, that maintain the largest concentrated short position in any commodity ever traded ever on COMEX in silver, about 700 to 800 million ounces short, as dumb as a mud wall, when the rest of the world is accumulating commodities because of the things I just mentioned, the lack of trust, the inflation, the realization that we can't normalize our balance sheet, that by pivoting proves that when they are 60% away from their target of 2%, that's not signaling victory over inflation, it's waving the white flag. And I think you can see that by the back end of the market throwing up and selling off, and the interest rates going up by 60 basis points 2 weeks after they lowered the front end down by 50. That's the back end's way of saying, no, you're trapped and that's not going to happen. So what I guess I'm simply saying is that I don't think we're in the first inning of the gold bull market, but all things considered, the environment today points to gold having a good deal of room to run before we hit the later stages of this cycle, because all of this movement has been void of American participation. As my good friend Rick Rule often says, you take Joe and Jane six-pack all the way up to the Harvard Endowment Fund, and what you see is a 1/2% allocation to precious metals. A 5% allocation is a tenfold increase. And I think you see bank failures like we saw in Lindsay, Oklahoma. Most people don't even know what a bank bail-in is. And we just saw the first one and not a word about it. You know, we bailed out Silicon and Signature with hundreds of millions in uninsured deposits. But the 7 million in uninsured deposits in Lindsay, Oklahoma, 3.5 million say bye-bye to. It ain't coming back. And that's a trial balloon. Wait until there is something, whether it be the commercial real estate eroding to such a point that we start to see real bank failures with real uninsured deposits bailed in as part of the Dodd-Frank Act legislation. And there's an awakening when people say, my God, why have I not listened to Alasdair Macleod all of these years? Why have I not put some money into precious metals? And when that happens, bang, like that, you ignite the realization that there is no bull market like a metals bull market. And in that environment, the people who have made big profits in dollars, they're not going back into dollars. Are you kidding me? I don't care what kind of profit it is. So the secondary market's gone. And the fragility of this market in an asset that is, becoming harder and harder and harder to get, I think becomes stark. So we have a long way to go. Yeah, if you're late to the party, it's, you're not even in the third inning yet. There's still time, but I think it will be the latter parts of the game as you get to the end that will be what everyone who's been holding for this long probably witnesses, and be careful what you wish for. That will come at the expense of the dollar. So sorry to be so long-winded, but I think we're a long ways away from the end. And, with the American participation completely absent. In fact, one last statistic I think that I have here. Boy, I think I have it. If I don't, I'll let it go. Oh, here it is right here. Despite gold and so I'll just read this verbatim. Despite gold and silver's strong performance, they're still far away from mainstream. 2023 Bank of America survey showed that 71% of financial advisors had a 0 to 1% allocation to gold. There's Rick Rule's point there. While only 27% had a 1 to 5% exposure, and shockingly, just 2% of advisors reported a 5 to 10% allocation, underscoring gold's low profile among Western investors. We got a long way to go, you guys.
Absolutely. Well, I would like to then pivot to how people can put this information to work by discussing your individual strategies for investing in the gold sector. Do you believe in holding physical gold, mining shares? Do you hold for the long term, trade more frequently? Any thoughts on the ETFs, both the physical ETFs such as SPROTS, PHYS, or the mining ETFs that hold a basket of mining shares? How do you approach investing in the gold sector? Andy, we'll start with you this time around.
Yeah. So when I started my company, Jesse, I was 19 years old, and that was almost 35 years ago, 34, almost 35. And my dad's middle name is Miles, and his best friend who lent us $60,000 to start our company in a room the size of a closet, one room office, literally the size of a closet. Before the internet, his middle name was Franklin. I am the least likely person to have succeeded the way that I have. We eclipsed 10 billion in sales, and I pinch myself every day. How the hell did I get here? When I started the company, my father said to me, Andy, I will never let you make the same mistakes that I made as a younger man. There will be one rule or I'll fire you. Okay, Dad, what's that? You're going to buy something every 2 weeks. I don't care if it's 1 ounce of silver or 1/10 of an ounce of gold. You will do that or I'll fire you. Now I've owned the company outright pretty much for 2 decades. He's still my partner. He won't fire me anymore, but I've honored my word to him. And I have purchased something every 2 weeks for 35 years. And I've learned the most valuable lesson. The best gift my father ever gave me was the understanding of compounding, the compounding of time, compounding of interest, in this case, the compounding of time, the lesson of paying myself first. I look at gold as wealth. I own it as wealth. I am far more comfortable owning more gold and silver physically than anyone would ever say is rational than leaving large amounts in a bank. Ask the folks in Lindsay, Oklahoma about having money outside FDIC coverage, which, by the way, only has 148 billion backing 18 trillion of deposits, but I digress. I look at gold, physical gold and silver, as wealth. Wealth that has outlived 2 world wars, German hyperinflation, the Great Depression, every pandemic, anything the world's ever thrown at it. And here we are, 5,000 years after it's mentioned, I don't know how many times in the Bible, hundreds of times, and you have the most well-funded and well-informed traders on the planet buying it at a level the world has never seen, that being the central banks. It is not an investment. You didn't have pharaohs and kings and queens and emperors calling their gold dealer to buy gold. They owned it as a form of immutable wealth that they would have if they needed it for whatever that opportunity or an emergency. People look at it only as an emergency hedge. No, there are opportunities too. And gold has outperformed just about everything over the past 20 years. And I can redeploy it into whatever I want right now. It's not just for emergencies, but it's wealth. It's wealth that I hope I don't need to use. And if so, I can leave to my children, knowing that in the year 3000, long after what we call money, the bills in our wallet are hanging from a frame in the Smithsonian as an example of what used to be, that gold and silver will still be wealth. And I do believe that. Now, I have been fortunate enough to work with Rick Rule through the years, and became a friend of mine and trusted me with working with his clients when he was at Global Resource and then at Sprott. And I owe these folks who have been with Rick for a very long time at both Global and Sprott an awful lot. And as a result, I have always maintained a mining share portfolio. Mining shares to me amplify returns. Mining shares to me offer growth potential that you won't find in physical metals, but that cuts both ways. That volatility cuts both ways. In other words, that leverage can really benefit you on the up and can hurt on the way down. Mining shares to me are an incredibly underloved and undervalued and underappreciated asset class that when we talk about asymmetrical profile, I look to silver and I look to mining shares as two asset classes that have insane upside potential with very little downside risk. So I own some, but in a financial pyramid, if you will, that I learned because our business was founded on Swiss investments. First couple of years, I spent summers in Zurich learning because we were the contact for a wonderful company that I still work with today called BFI Consulting. Alasdair, you may know who they are. I'm not sure. Frank Seuss. But we were the contact for the Swiss insurance industry. And I learned from Swiss bankers who, even in best of times, would have minimum of 10% of their assets in gold. They look at it very differently than the West does, who has nary a half of 1%. But the point is that the Swiss have a pyramid type of portfolio strategy where the base of your pyramid would be things like paid for real estate and physical precious metals. You could say cash. I guess you could, even though it's being debased. But so what? Cash. The things that are low growth, low yield. The middle portion of the pyramid would be things like 6-month treasuries throwing off 4.5%, or utility stocks paying a little bit of a dividend, a little more risk, a little more return. And the top 10% of your financial pyramid would be your cryptocurrencies and your mining shares. I don't care if it's the majors or the juniors, or the exploration. That's where they go. And the theory behind it is that you lose everything on the top 10, heaven forbid. You don't make a nickel on the middle, but you aren't going backwards because of the slow progression, stability of the base of your pyramid. You never go backwards. Now, in a perfect world, you hit a home run on the mining shares and you do just fine on the middle portion, earning your 4 or 5%. Then the base of your pyramid is not risk to speculation like Exeter's pyramid. This is the building a balanced portfolio where gold is at the bottom and mining shares are at the top. But I think there is room in everyone's portfolio for them right now, especially because if you look at where they're priced right now in relation to where metals are priced, they're wickedly, wickedly, wickedly undervalued. So I would suggest that everyone have a position in mining shares up at the top 10% of their pyramid. Do not invert your pyramid to speculation. Understand they offer amazing potential, but that cuts both ways. That's for the physical metal, and there's room in everyone's portfolio for both.
Great. And Alasdair, your approach, your strategy for investing in the gold sector?
Yeah. Well, first of all, I don't give investment advice. I want to make that clear. So I'm making general remarks. I think probably the most sensible way for an individual to look at gold in particular, I think we'll put silver to one side, is as an insurance policy. We get on with life. We've got things to do. We've got a house to live in, which has got value. We own other people's debt, like our government's, which we can value because that is credit, which can be transferred. So we can value all these things. We can do all our activities, but just in case something goes wrong with the value of credit, it does make sense to have an insurance policy. And I think it was Andy was saying, if you go back to, well, certainly the 1970s, you were looking at having 10% of your portfolio in gold, maybe even 15%. And in those days, you couldn't actually buy gold because it was banned in many countries. But nonetheless, it was a sensible portfolio. And instead of gold, you would have maybe gold mines or something like that as a significant portion to insure yourself against the possibility of a currency crisis or a credit crisis. And I think that's still the best way to look at it. Can I sort of just diversify the thought slightly?
Yeah, of course.
I just wanted to pick up on something Andy was saying that the gold ownership is in the order of about 1%, 1.5% tops maybe. And that is clearly absolutely wrong, given that we have these enormous and very obvious risks facing credit, whether it's banking risk, whether it's currency risk. I mean, all these risks are actually very, very serious. So to have an insurance policy, as it were, which is only 1.5% of the total, I would say is really rather bizarre. Let's put it that way. What will happen is that people will begin to understand this, obviously, rather late in the game. And it's all driven by an emotional approach to the value of assets. I mean, we see this in bull markets. Who participates in the top of a bull market? It is always the individuals. It is always the little man. And he, of course, buys in at the top and he makes the losses when the markets go down. And it's going to be the same with gold. There is absolutely no evidence, really, that the ordinary person in the street is even trying to understand what's going on about gold. I mean, I see this in terms of the interest on my Substack. It is right that the ETFs are beginning to tick up in terms of bullion, but I suspect that is particularly true with large institutions beginning to understand the argument, the debate that we're having, that there is this risk and they better balance their portfolios a bit towards gold. But I think as far as the man in the street is concerned, he's not there at all. So the sensible thing to do, I would suggest, is get in ahead of the man in the street, because there will come a point where he does really get in, but it's not yet, nowhere near yet. And the level of interest, and I was fascinated with what Steve was saying about his indicator, the level of interest amongst the general public is virtually zero. But of course, amongst trading hedge funds and all the rest of it, it swings from positive and negative, positive and negative. And there's something interesting too in the current situation, because normally what the hedge funds do is they sell dollar by gold or sell gold by dollar. They see it as a pairs trade. But now you've got, not only are they long of gold, I mean, if you look at the COMEX figures, it's not really all that overbought yet, but it's moving in that direction, which basically tells us that the hedge funds are in there chasing momentum. But at the same time, the dollar's going up. And so it's changed slightly from being that pairs trade into something slightly different. We don't know quite how that's going to work out, but just watch the overbought, oversold side of it, perhaps in terms of open interest. The weekly commitment of traders figures will tell you what the managed money category is doing, and so on and so forth. You can get a pretty good idea as to the sentiment in the overall market from that. And that sentiment is also pretty much reflected, I think, in London. So what you see in COMEX is actually a pretty good indication for everything else. So we have yet to see people really come in and understand that this is an insurance policy which they should have. When they do, where is the stock going to be? I mean, it's absolutely nowhere. There is not enough physical, particularly with Asian demand, which is really taking out all the excess. And one of the other things that's interesting, talking about mines, the mining sectors like the HUI index has been outperforming NASDAQ now for virtually all of this year. And of course, I don't think anyone has really sort of latched on to the best way to get your portfolio performing is to rebalance it towards mines. They only just started doing that. So there's a long way to go in this game. And I think that's the context in which you look at your allocation to gold, silver, and similar investments.
And Steve, how are you playing the gold sector? Are you doing these shorter term trades using this indicator, sentiment indicator? Are you more of a long-term buy and hold? Do you believe in holding the physical as well as mining shares? What's your approach?
Well, I've been on the long side for a long time because I'm a little bit like everybody that's on this panel today. I like long-term insurance, so I'm kind of old school in that regard. But the new element is, in fact, the trading, not investing. Again, the Hanke Gold Sentiment Score, it's a trading aspect. If the market is completely flat and it goes throughout the year, and the price at the end of the year for an ounce of gold is exactly what it was at the start of the year, you can do very well trading the gold sentiment score with flat prices. So that's a different angle on it. However, it's not only been a profitable one. That's one obviously where you want to be if you're in a profit and loss system, but it's also it gives you a much better feel for what's actually going on in the market sentiment, as we call it, the gold sentiment score. So I think some trading is warranted, at least for some people. But most people, it's go to bed and sleep well and soundly at night with insurance, and the old 10% number was thrown in there by Andy and Alasdair, and that's fine with me. I would, by the way, the only thing in terms of investing that I would suggest, and I'm like Alasdair, I'm not giving investment advice, but just as a general thinking, if you buy the idea that we're in the early stages of a gold bull market, I would consider leveraging up a little bit.
Very interesting thoughts.
Going flat with this is for the investor / speculator. You want to play the market with a little bit of leverage.
Great. Well, yes, nothing on this show is investment advice. Do your own due diligence. We always give that disclaimer. Well, gentlemen, we're going to be back for part 2 next week, where we are going to be answering the viewers' questions. I am beyond excited for that. So that's a wrap for this episode. Before I do let you all go, let's discuss your individual endeavors. Steve, I know you have a new book that you want to talk about. Why don't you tell us about that?
Well, the book I wrote with a great economist and polymath, Leland Yeager, it just came out about 3 weeks ago, Palgrave Macmillan. It's called Capital, Interest, and Waiting. And the essence of the book is it's capital theory. So we go into many of the historical controversies and unsolved mysteries around capital theory. We think we got them nailed down. But the big thing is that waiting is in the title. And waiting, we have developed, is a factor of production, like land is a factor of production. It gets paid a rent. Labor is a factor of production. It gets paid a wage. Capital is a factor of production. It gets paid an interest rate. And waiting, that is not consuming today, gets paid an interest rate. The interest rate is what you get paid for waiting. And waiting, if you take waiting out of the production process, the level of output in the economy and prosperity go down. So waiting is a factor of production. It is a good thing, and it is something that is rewarded by an interest payment. So that's the essence of the kind of breakthrough in the thing. So it opens up the paradigm for the classical economic production function, land, labor, and capital. Now we've got land, labor, capital, and waiting in the picture. So you can purchase the thing it's on Amazon and all these on online vendors, but you can buy it as an ebook or at a bookstore hard copy.
Great. Well, I'll put a link in the description below to the Amazon link so people can purchase that. Alasdair, tell us about Gold Money, what it is you do there and where people can find it.
Yeah, well, basically what Gold Money does is it offers a bullion dealing and storage facility outside the banking system. Now, this is very important because, when Roosevelt confiscated gold and gold certificates, it was really the banks, if you had it in the banks had to hand it in. And private individuals basically didn't. They didn't go with it. So the bank, having your stuff stored in a bank, whether it's on a custody basis or, let's say a bank's liability to you, is not a good idea. It really isn't. And that's where Gold Money comes in, and it offers storage around the world. But what I'm doing more than that is I'm concentrating on trying to educate people about the role of money and the role of credit, the difference between the two, and to try and inform them so that they can really take the decisions that they need to protect themselves in a world which is with mounting risks. I mean, we've talked about debt traps. If you look at the central banks, they're all deeply underwater because of the bonds they have bought at far higher prices than the current level. You can recapitalize central banks, but I particularly worry about the ECB, which I think is virtually impossible to recapitalize because of its structure. And so we have the potential, I think, for an awful lot of risk suddenly mounting up, which could destroy credit. And I just want people to know about that. So that is really the focus of my Substack. It's to inform people, educate them, pass on information which is relevant, and so on. And that's alasdairmacleod.substack.com.
Great. There'll be a link in the description below to both Gold Money and Alasdair's Substack for those who would like to check it out. Andy, tell us about Miles Franklin Precious Metals.
Yeah, absolutely. Alasdair, I can make it real easy for you too. JP Morgan did say gold is credit, gold is money, everything else is just credit, I think is what he said. So, but I just am meeting Steve here for the first time, but I've been a big admirer and follower of Alasdair's work, and everything he said is very true. I encourage people to check out both of what these guys have to say. Miles Franklin has been in business now for 35 years. We are a precious metals company. We have relationship with BRICS. We have 9 vaults around North America, some exclusives in our location and in our safe deposit box program and in our fixed rate structure. I would like to think that in North America, we are pretty much the envy of the storage industry. I work with Glint as the U.S. representative, Jason Cousins and Glint, a MasterCard program, metals held in vaults in Zurich. The ability to access it, and again, outside the banking system is the point I would highlight. We do have our own YouTube channel, which we just started, and Alasdair was kind enough to come on. Don't be surprised, both of you, if you end up receiving an invitation to come on as well. I would be honored. And it is a channel that focuses more, not so much about the things that we're talking about here today, because I did 21 YouTube videos last week, believe it or not, talking about all of that stuff. It's more about what makes you tick. How'd you get here? Where'd you get that realization? What made you cross that bridge? And when I would follow Richard Russell, my mentor growing up in this industry, it was more about him as a person. After I read him and understood his economic and monetary outlook, it was him as a person that I enjoyed the most. And if I'm going to listen to these people and follow their work, I'd like to know who they are. Like if we're sitting having a glass of scotch and talking, that's the kind of conversation that I like to have on my YouTube channel. And of course, we do sell precious metals. milesfranklin.com for our most comprehensive price list that is not listed on our website. We do publish prices limited for small orders, but our price lists that people can request without any obligation will be amongst the best in North America. That is info@milesfranklin. Just tell them you saw this show with Jesse and the panel in the subject line, and we'll make sure your listeners are getting as good of a price and white glove service as they'll find anywhere in North America. Again, that's milesfranklin.com, info@milesfranklin for questions or just our price list. And on YouTube, Miles Franklin YouTube channel, check it out. And Jesse, I always enjoy my conversations with you, even more so when I get to sit in the company of two very, very smart guys. I'm humbled to be here, and I look forward to continuing with part two and picking up where we left off.
And thank you for joining us today. As a reminder, this episode brought to you by ARC, silver, gold, osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. All right, I'll see you guys next week for part 2 of the Ultimate Gold Roundtable. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.